One of the most notorious months in the investing calendar has arrived with a bang. You've likely heard the expression, sell in May and go away. And after all that's happened this week, you may be tempted to act on it. But I can almost guarantee you've never heard of the earth-shattering Wall Street event headed straight for US stocks in less than 60 days. Now, the date is all set. It's coming. 63 funds are actively preparing to send shockwaves through over $10 trillion of American wealth. And you have mere weeks to get ready before a wave of volatility crashes over half of the US stock market. My good friend and brilliant forensic accountant Joel Littman is stepping forward to help you protect yourself and get ready on Wednesday, May 10th. If you have any money in IRAs, 401ks, annuities, pension plans, stocks, or bonds, I urge you to give Joel's warning your most serious consideration. It couldn't be more important to protect your wealth in the weeks ahead. Again, Joel will go live on Wednesday, May 10th with all the critical details. Head to 2023warning.com now to make sure you're on his list for updates. Again, that's 2023warning.com. Don't miss it. Hi, this is Daniela Cambone. Happy Friday. Welcome back to the Daniela Cambone Show. We are talking of the ongoing banking crisis. The market keeps looking for the next domino to fall as banks continue to feel the pressure. Joining me today is E.B. Tucker, author of Why Gold, Why Now. He's also the publisher of the Tucker Letter. E.B., always good to see you. Thanks for coming on.
Thanks for having me.
So let's talk about what is happening on the banking side of things. Of course, we're going to talk the Fed and many other topics. But first, I want to get your take on the banking crisis. I've had some experts coming on saying, look, it's overblown. It's going to stay at the regional level. We don't have to worry about the big banks. But the dominoes just keep falling here. EB, what's your take?
Well, banking is super complicated. I mean, everybody thinks they put the money at the bank and, the bank holds on to it for them. But as we all know, there's, $18 trillion of money at the bank, and which is far more money than we put in the bank. It's very complicated. And I think what people need to realize is that the Fed caused this. And I had meetings with First Republic. Many of my friends banked there. And I remember them explaining to me what was possible. You put your stock there, they'd loan back the money to you. You could do all these creative things. And I couldn't believe the interest rates. And what basically happened was First Republic was responding to the Fed's incentive. The Fed kept rates so low for so long that any banker with brains was like, let's go out and loan as much money as we can, and we'll lock in, we'll loan the money at say 2% and then lock in, a rate 2.5%, in a mortgage instrument or whatever. And they did this to great excess, and all the banks that did this are now obviously crippled under the weight of 5.25%, which is the new Fed funds rate. So look, you can't blow this gigantic balloon up and then shrink it back down a little bit without casualties. There's going to be more of them.
Okay, so let's tie this into the Fed because you brought them up. We had the big Fed meeting this week where Powell continues to sound resolute. He's still quite hawkish. He's not stepping away from his 2% inflation target. But were they wrong to keep raising rates here?
Well, I mean, it's a centrally controlled system. I mean, we don't have a market economy. We have a centrally planned economy. And so he's not wrong. He's just, it's a well choreographed show. It's kind of like, if you're watching wrestling and you say the Nature Boy is really going to beat, Rowdy Roddy Piper tonight, I really know it. It's a well choreographed stage show. The Fed has a difficult job. If they don't raise rates, the dollar loses standing around the world. If they do raise rates, they cripple their domestic banking system and everybody freezes in place. I want you to think about something with housing that's very interesting. You might know, many of your friends might have mortgages from the pandemic era that are very low, and they don't want to move. And so they're not moving because of mortgages. So they're not moving because they like their neighborhood. They're not moving because they're pinned down in a 3% mortgage and the new mortgage is 7%. You see, this is the Fed's reality that they've created for us. They have incentivized us to behave a certain way by pumping money into the economy for years and years and then pulling it back. And this push and pull is not market forces. This is a centrally planned system. So Jerome says things that are choreographed and planned. He has excellent PR people working for him. I wouldn't pay any attention to what he says. I would realize that what's happening is you got to look at people's attitude. And the attitude of market people in the US is kind of like wanting your house to burn down so that you can get the insurance money. Think about this
Right,
for a second. What's
right,
happening is people say, we're going to have a recession and it's going to be great because then the Fed is going to lower rates and pump money into the system. But the reality is, when we have a recession, people lose their jobs, government doesn't receive as much tax revenue, businesses fail, people are stuck. Everybody spends through their savings. There's a lot of pain and discomfort. And everybody's excited about that yesterday because as soon as they hear, oh, goody, the rates aren't going to go up anymore, it means that they're going to pump money into the economy and stock prices are going to go higher. During a recession, when people are losing their job and nobody can afford anything, they spent their savings. And everything you buy, by the way, it's shooting up in price. I mean, I don't know anybody that's like lowering the cost of their labor or deciding now I'm going to cut prices. Everything goes up and stays up. So think about it from that context. And then you start realizing with very sober view of things what's happening. It's a centrally planned system. The Fed has to protect the dollar or else the empire loses its currency. You can't have that
right.
happen.
And that's another topic. You just hit on a few major points there. I hope to cover all of them. So you're absolutely right that this era of free money has created all these enormous distortions in the market, EB. And it's also quite clear that the only way to stop these deposits from leaving the banks and blowing up the whole regional bank ecosystem is if the Fed were to stop raising interest rates. So don't you think they'll be pushed into a corner to stop? Or
Yes.
do you think there's a
Yes.
narrative, like, do they want to blow up do we need the regional banks to have this ecosystem working?
You need regional banks. The guy, you can't see the picture of my grandfather on my desk, was the chairman of a bank and taught me a lot about banking. You need regional banks. I mean, regional banks are like utilities for money. I mean, you have to have some sort of interface. You can't have JP Morgan be the bank of the country. It doesn't really work because JP Morgan doesn't really know about your local area where you want to build a duplex or something. You need a loan for that. It's kind of like just a little bit too theoretical to think that they want to blow up all the banks. Maybe you have too many regional banks. Maybe you have too many small banks. Maybe you need to consolidate these banks. But there's thousands of banks in the U.S. and there will still be thousands of banks. Maybe we just clean up a few of them. But the reality is the Fed will have to stop at some point, and it needs to push it as far as possible because the U.S. has lost standing internationally. And there's a lot of different countries, sovereign states, that don't want to deal in dollar terms anymore. And the Fed has to protect the power of the dollar without crushing its local system. And if you look, there's more room for this to go. It doesn't mean, so everybody says, oh, does it mean the rate's going up? It doesn't matter. It doesn't matter what the number is for the rate. What matters is, people are spending through their savings. So how long can they do that? People are not feeling pain yet. And if you don't believe it, go to a restaurant, go somewhere where you have to interact with crowds of people, go to Disney World or something. I mean, watch the enthusiasm of the people. They're kind of just complacent and spending, and there's no discomfort. So they'll run until they see discomfort. My friend Tom Dyson says they'll push it until you see the whites of their eyes. That's when it stops.
I live in New York City, the most expensive city in the world right now. And a tweet I saw the other day really resonated with me from, I guess she was a fellow mom, who was saying, you're better off not leaving the house with the kids because every time you leave, it's like you're spending minimum of $450.
Yeah,
and that's
it's expensive.
So this is exactly the world that we are living in, and people are not feeling that pain.
There's no problem
yet.
Yeah.
But a counterpoint I wanted to bring up. Okay, so I had Joseph Wang, aka the Fed guy, on, who made the case that the banking crisis is completely overblown. The two data points he follows are the Fed balance sheet data and the prime money market flow data, which he says are showing encouraging signs. So when a bank is in trouble, they borrow from the Fed as the lender of last resort. Weekly Fed data shows that borrowing is declining, and we also show that money is going back into prime money market funds. Prime money market funds lend to banks, and during the panic, people are pulling money away from the prime money market funds, and that's all coming back. Any thoughts as to this counterpoint?
It's extremely, yeah, I mean, he's a smart guy, but it's an extremely complicated situation because you have scenarios where people finance things at, say, 3%, and now they're rolling over loans at 6%, and then the business is slow, and then they say, wait a minute, we actually don't even have the EBITDA necessary to borrow with that same capacity anymore. And so what you've got to realize is that everybody wants a static solution to everything. There is no static solution, it's dynamic. And we're in a scenario right now where if you borrowed big and to finance something, and that something is seeing declining sales, then when you have to go re-up that loan, because you don't have that cash, you don't have the $10 million that your business borrowed, you need to go re-borrow that money. The banker at the time said, don't worry, rates always go down. But you come back in and it's 8% or something. I can tell you right now from the boards that I'm on, I'm connected to many, many people. The international, private equity funds, the big funds are telling me that like 10% is the baseline rate, for lending, in different mid-market corporate strategies. 10%. I mean, imagine if your profits are down, your sales are down, and you try to borrow at 10% when you were borrowing at 3 or 5, forget about it. The business is insolvent. And so you can't have rates that go down for 20 years and stay at zero for many, many years to finance crazy businesses, houses that you don't need, cars that you don't need, all these things. You consume all this. You take the money and you consume as well. You buy stuff and you do things that you can't get back. And now you're spending through your savings. You're losing your job. People are losing their jobs. They're running out of this money. And then they say, well, I'll sell these 3 Rolexes that I bought. Guess what? You start flooding the market, and then people aren't willing to pay. How much money do people actually have? Not much. They have not that much money. And so you're going to go until there's massive pain, and you wait and see how fast some of this prime money gets wiped out. Some of this money, these things that we look at, gets wiped out when you have, a high rise that can't roll over its debt. It's this huge $300 trillion of liabilities, floating around in this system. I mean, imagine what happens when you change the borrowing rate in a fully leveraged system.
And another point I wanted to bring up, and we can move on from banks here, was from billionaire investor Nelson Peltz, who also warned that more regional banks will fall unless regulators change the rules for depositors. So I want to know what you think about this suggestion, a renewed suggestion that he brought back for depositors with more than $250,000 in U.S. banks to pay a small insurance premium to the Federal Deposit Insurance Corporation. He said, quote, "It should stop the deposit outflow from the small and regional community banks. I don't think we want all of the funds just going to major banks." Is that a good solution for you?
Imagine it's like you're paying insurance on your money now. I mean, why would you not just have a bunch of gold coins? It's like it defeats the whole. People just, where are you going to go with this money? That's what people don't understand. You should I move to this bank and this bank? And imagine then they say, okay, we'll charge you a little fee to keep the money over here, and then you're going to freak out and I'm not going to pay a fee. I'm going to move the money somewhere. And people just, it's like playing dizzy bat. They just have no idea what to do. The fact is, you need some money, you need some liquidity, right? The reason why you need that is to buy stuff when it's on fire, right? Remember, Bank of America went to $3 in the financial crisis, but nobody had $3 to buy a share of it. But the thing is that you got to have some money to take advantage of, once every 10-year opportunities to buy stuff. Okay, but then you got to have some wealth protected, right? And then you just got to have people get very extreme where they're like, should I move my money from bank C to bank D because there's a problem? It doesn't matter. It really doesn't matter. I mean, the even wealthy people that I know are totally baffled as to what's going on and what to do with their money. You should hear these phone calls that I get. It's crazy. Well, I'm not confused. Yeah,
I know you're not.
It's wild.
Well, let me bring this up because I know how much you like treasuries. And but the counterpoint that comes up is like, why would you be moving into treasuries considering the trillions of dollars of debt that the government's in? How is
Yeah,
that
so I mean the
a
problem.
viable
Okay,
option?
so I do like T-bills. I mean I bought. I'm trustee of a trust. I've been buying 90-day T-bills or over 5%, and everybody's the debt ceiling and the federal government's revenues are down, but it's all true. So, but you got to remember something is that it's a piece of the puzzle. I don't think the U.S. government fails to pay back the T-bills. I think it's absolutely insane. And if that happens, then what is going to happen to the rest of your stuff? I mean, it's just people just they look for a static, single pointed solution for everything. If you say, oh, you got to be over here at this one bank, that's going to be the ticket. You're going to be a genius, and everybody, the U.S. government's going to fail to pay back its T-bills, but you're going to be smart over here at ABC Bank. Forget about it. I mean, look, you're managing an empire. You have to understand if you're even, so you might say, oh no, I only have a small amount of money. Yeah, well, guess what? If you lose that money, you'll have zero money. So then you'll start over. So you have to see yourself as being responsible for an empire of wealth. You're building this empire. One brick at a time, you're building this empire. And you're not trying to be a genius. Yeah.
And you have
You're
to
not
be
trying to outsmart everyone. When I
right.
bought rental houses in 2009 and 10 for $10 a square foot, I bought these things at absolutely prices now that people don't even believe except I have the records to show them. And I sold them for very high prices. And people say, well, wow, why didn't you buy more? Guess what? It was very scary because no one was buying real estate at the time. And it was very risky. And nobody would finance it. And you had to have cash. And I only bought about 6 of them because I didn't have like unlimited amounts of money. I was working for 10 years before this happened. I saved what I could. Okay, people need to understand you're not trying to outsmart this system. You're trying to survive and trying to protect your empire. And then you're trying to grow your empire when you can. And that's, once people see it that way, it makes a whole lot more sense because you would never wildly swing your empire way in one direction and then way in the other direction. You would get whiplash.
Would you add it's important to be your own bank? Do you feel comfortable with that sentence?
Well, so I like to think, I mean, I am a trustee of I've started really being, in my newsletter, I write about this, like how I was hired to be trustee of a trust. And my job, it's like parking someone's Ferrari. I mean, you have to be very careful. I mean, you can have an accident, but you have to be very careful. So you have to be able to explain that you tried to park the Ferrari and maybe you ran into something, but it was an accident. You weren't being reckless. And so when you look at being your own bank, what are you trying to do? You're trying to protect some savings. You're trying to maintain liquidity, and you're trying to also maintain exposure to certain assets. I mean, people are always shocked that I run a portfolio in the newsletter. I run the trustee portfolio that I manage for the trust. And I show people I do buy some stocks. And I explain why I buy the stocks that I buy. I mean, I'm not one of these people that's like, you need, 90% gold and, 10% strange collectibles or something. I mean, you can't manage life that way. You can adjust things as you go, but your job is to float down the river of life and to not fall out of the boat, in one of the rapids. That's the job.
And I want to get back to more of your game plan. But here's a quote, because you brought up, recessionary odds pretty darn high right now. DoubleLine CEO Gunlock agrees with that. And he also said this. He said, markets for risk assets are too complacent given this cocktail that we have of credit contraction, QT, higher interest rates. He says we should expect higher default rates and lower quality fixed income securities as we move into the end of the year. So should investors be upping the quality in their bond portfolios here?
Well, he's right. So like the thing that's happening right now that nobody sees happening is that the assets that were super popular last decade. So everybody's fighting the last war. Those assets, people have just frozen in place. Okay. And I was talking to someone last night that was a JP Morgan private bank, and we were talking about the lending that people would have, like, $30 million there. It's in all these ETFs, tech ETFs mostly was what was hot. And then people borrow against these things and they buy like a second home. And then the second home is going down in value. Better sell that. Can't take a loss. Cost of borrowing is going up. Well, wait a minute. Also, those stocks are going down, but they haven't even sold any of them yet. So there's a lot of air to come out, whereas there's some parts of the market that didn't benefit during the last 12 years of free money. I mean, if you didn't, there's some parts of the market that just chugged along making real things and making 10, 12% net profits. And people were like, we're not going to buy that because it's not tech. So everybody, what Gunlock's talking about is as the air comes out of some of these things, you realize what's actually going on there. I mean, you're seeing it now with Blackstone's real estate fund, all these different things that are happening. There's defaults going on in commercial real estate. People are just frozen in place, and they're like, well, I guess it'll come back, or I guess I'll make it up on dividend, but the dividend was cut. Well, I'm certainly not going to sell now because I'm down. You see how this mentality goes? And then they're going to run out of savings, and you have to sell. That's what's going to happen.
So do you think stocks will crash this summer?
Well, back in February, I said publicly that I thought stocks are correct by 20% by the summer. Now, what we had was in March, we had a little correction. And then now we've had a short-term reprieve. So now it's the time to rebalance the portfolio and to get out of the riskiest parts of the portfolio. And what you want to own is things that you would be happy owning if the price went down by 30%. Okay. People are like, well, why would you want to own anything that's going to go down 30%? Because you're managing an empire. You're not speculative day trading. All right. So if I own a company that's the largest producer of commercial French fries in the country, I don't want to sell that, because the market goes down 20%, because I realize that French fries are an addictive food substance that Americans can't get enough of. I'm happy to own that company. It doesn't have too much debt. It doesn't have, too many issues that are going to impair it from being a long-term business. However, if I owned a fake meat company or something that was a really hot stock when everybody was stuck at home gambling, maybe I do want to sell something that was more of a fad. Okay, so I want to rebalance myself into things that I'm happy to own because I want to own that business. I'm not necessarily that worried about the short term. Does that make sense? And people don't do that. They don't do that. They don't understand what they own. They don't understand why they own it. They're totally confused, and then they're just whipsawed by emotion.
Because it involves a lot of brain power and homework, right? It's like, I'm not saying, my viewers, but a lot of folks just want to be told, buy this stock, okay. Buy this stock, okay. Right?
Yeah, and then it didn't go up enough, so I want to buy a riskier stock because I want to make lots of money overnight. But basically, look, ebtucker.com, this is the whole premise, was that I had so many people asking, what do we do? That I said, all right, I'm gonna write to you from this desk twice a month, and I'm gonna tell you what I'm up to and what I see going on. And some people don't like it because they just want the answer. And I'm like, you got to understand something. I'm not confused because I'm thinking this way for 25 years, and I'm going to share it with you. That's the deal.
Just before we wrap part one here, I have more EB Tucker coming up, so don't worry. But part one here, on the gold part, right? Yes, EB, I know you love royalty companies. But in terms of physical gold, what do you think about the collectibles? Because a lot of people are asking me, should I be into collectibles?
Yeah, I wrote about this. I wrote in my book. I have a whole chapter on this.
Okay.
I have a whole chapter on it. People have got to. They have to first say it's a no-fly zone. But if you decide you get interested in a certain type of collectible, then it's very fun and very profitable. Because what happens is like, for instance, in my office, you can't see over here, but I have a 1973 Eames lounge chair. It's a very famous classic lounge. I learned all about them. And then I was in a estate sale and I saw one and I looked at the label, I identified the year. Nobody knew what it was. And I bought it and had it refurnished. That's an example. So with collectibles, with collectible coins, you can have a lot of success. However, you have to decide that you're going to get very interested in, early 20th century Liberty, $10 pieces. And then if you do that, then you can have like loads of fun collecting coins. But if you just say, you know what I'd like to do is buy a random collectible coin from an unknown source on eBay, you have no idea what you're doing.
And that's why you say it's a no-fly zone, if that's your
Exactly.
path.
So
Okay,
it's kind of like, there's a lot of things in life where people get confused. I say, this is something you absolutely can't do. But if you learn all about it, then you could do it and have a lot of fun.
Yeah, but everything just, sounds complicated. Isn't there an easy path?
It is complicated. It is complicated. And you're going to get fleeced if you think that it's supposed to be simple. Because when somebody packages something simple for you and they say, hey, you know what we've got for you is we have a lifetime of annuity payments for you, and all you got to do is sign right here. And then 12 years later, you're like, they ripped me off. They did not rip you off. You came to them and asked for something simple that's not simple.
Therein lies
they said,
the lesson.
we have the thing for you. Yeah. So I love collectible coins. I love collectible coins. And you have got to be a complete nerd to like collectible coins, and I love them. I've always loved them since the first time I ever learned about them. When gold was about $350, I learned about certain type of St. Gallons. I love them. But I tell people all the time,
you got to go down that rabbit hole, though.
You better leave that alone unless you want to decide that you want to learn about them. And people just don't have they're too busy. They're too busy sitting on the sofa and watching television to be troubled with any learning for the most part.
I'm going to end part 1 here. We're going to take a quick pause and be back with Evie because he's going to tell us all about how the Fed, in his opinion, is ruining our mental health. Why do I have a feeling that's going to have a lot of people tuning in for part 2? Evie, stay with me. We'll be right back. That was part 1 of my discussion with E.B. Tucker. We will be back with part 2, so be sure to stay tuned to the Daniela Cambone Show.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.